What hits on Monday will shock the world and send the market spinning. But what comes next? Well, Morgan Stanley says that's the real emergency. And that's why we're saying you need to prepare now. As Trump asked court to let him fire Cook, who warns of vote turmoil, and President Trump has declared an emergency, asking for an emergency hearing on Monday. Now, the significance of this is the Fed meeting starts on Tuesday. So if he can get Cook removed, well, that means her vote doesn't count. And right now, the stakes are high. And I want you to understand the key points of why this is so important, because right now there is a major focus on rate cuts, and we know that Fed Chair Powell in the past hasn't wanted to do that. But President Trump's motivation isn't just the economy. There's a whole separate reason he wants the Fed to cut and cut aggressively. But one of the problems that I've cited is that rate cuts are not good. In fact, it's a warning sign that the economy is about to plunge. Problem here is the Fed is likely to cut rates come next week. The issue is it's for all the wrong reasons. And the bottom line is that President Trump wants Powell out. Now, what's ironic here is he was the one that appointed Powell to the post, but right now he's saying, look, it's time for you to go. In fact, we've seen the economy slowing down and you've done nothing. You've kept interest rates elevated. We need you to cut rates and cut them in a major way. So if you think about President Trump's move here, he's trying to get a new board member on before the next meeting. That's right, this could go through on Monday, but if he can get rid of Cook as well, what this is setting up for is dissent on the board. And even though he can't remove Powell, he's tried to. There's just no legal way to do it. What he can do is tilt the board in a favor of a rate cut and force Powell to do that. Because right now, again, it's all about replacing voting members, and that is at the forefront of what President Trump wants. He believes he can get the rate cuts he needs if he can get the members to vote for a cut and go against whatever move Powell wants to make and force his hand. Let's take a deeper look, because again, on Monday, this is all going to shake down in a major way, could send the market spinning, because they've asked for a ruling by Monday, one day before the Fed's board starts meeting to vote on whether to lower interest rates. Cook can attend the meeting as long as the ruling remains in place. So if he can get this turned, well, that means she doesn't go to the meeting and her vote doesn't count. Now, this matters in a big way, and I'll show you why here in a moment. But according to her attorney, an administrative stay would threaten Governor Cook's participation in next week's meeting and potentially plunge the FOMC's vote into turmoil. Well, I don't really think that's likely to happen. We don't really see any infighting among the board or any turmoil of one member not being there. But let's look at the second issue here, because this one has real impact. Is the real potential of impacting domestic and foreign markets. And one thing we know is Wall Street doesn't like uncertainty. And right now, this is threatening to send the markets into a tailspin as they try to figure out what the Fed's going to do, where the economy's going, and how they need to be positioned. Because as we already know, when the Fed starts aggressively cutting, well, the next thing that goes is the stock market. But something that should be surging higher in a big way, that's your trading account. Let's take a look at this MetaStrategy trade we put onto all our subscribers for GDXJ back on the 5th. It's up 9.93%. Now, if you missed this trade, it's okay. You can get in on the next one because we have tons of trades. And right now, I've changed the game in terms of way people trade, because right now, every strategy is a one-size-fits-all. What we've done is optimize it on a per security basis, meaning we're putting up better trades with bigger win percentages just for you. Now, to get in on this, all you have to do is grab those links in the description below and use a coupon code for your free 30-day trial. Stay tuned to the end of the show, because I'm going to show you a direct comparison to one popular strategy called the Bravo 9. You want to see the difference? Stay tuned. Because right now, the Fed has 12 voting members on their board. The problem is they've got one vacant seat. Now, President Trump is hoping to get that filled on Monday, because remember, he's appointed someone else, just waiting for Congress to do their job on this. But if he can get Cook out, well, now you've got two vacant seats. Now, what's the importance of this? Well, Cook has voted right in line with Fed Chair Powell her whole time. So what he wants is her out, and someone who's going to say, look, I want to cut rates. Because something you have to understand about the board is it's not a consensus board. Just because, certain members want to cut doesn't mean that's the way it works. The way it actually works is what the Fed chief wants is what they get. It's his or her job to sway the entire board to vote alongside them. Now, the problem for Fed Chair Powell is he's had a lot of dissent, and that doesn't look good because, again, the markets want to see consistency here. So, in light that President Trump can't remove Powell, what he can do is restack the board with cuts. And Trump seeks to overturn a decision by U.S. District Judge Gia Cobb, who ruled that he likely did not have cause under the Federal Reserve Act to fire Cook over allegations she committed a mortgage fraud before her 2020 Senate confirmation. And again, this is going to all come down on Monday, and the outcome is going to completely shock the world. Now, I want to understand the importance behind the rate cuts and why what Morgan Stanley says is coming is going to be the real emergency. Because while it appears it's about the economy, while it may suggest that, hey, if we cut rates, consumers will come out and spend, the real issue behind them has everything to do with the deficit. Because it exploded in August despite rising tariff revenues as government spending is soaring. Now, first, the good news is the U.S. government benefited from outsized tariff revenues, which continue to rise and in August hit just under $30 billion. The problem is the deficit right now is running just shy of $700 billion a month, and that is not a good sign for the economy. So if you think about the motivation for rate cuts here, and you think about what Treasury Secretary Scott Bessent's likely to do, if they start to fund the government almost entirely with short-term debt or T-bills, what happens during rate cuts is as that debt matures and they keep it in T-bills, well, the cost goes way down. And right now, that is a big problem for the government. Let's take a look, because with total debt rising about $1 trillion every 100 days, it means that interest will keep growing too. And unless revenue grows in line, which right now, based on what we're seeing in the economy, is highly unlikely, we will reach a point where every tax dollar goes to pay down U.S. debt. As of today, interest expense eat up just over 23% of all government tax revenues, just shy of non-wartime record high. So again, you see the motivation here. You want to cut the deficit in a big way and keep spending? Get interest rates down. In fact, you get them down to zero. Well, the cost then gets pretty cheap. So you can see the motivation here. But again, the problem that President Trump doesn't understand is even though he wants rate cuts and he wants the Fed to cut rates, what he doesn't get is the Fed reacts to the economy. So when the Fed starts cutting rates, well, at this stage in the cycle historically, it means we're headed into recession. And that's not what he wants at all. Because if you look at the economy, we have evidence that it's going to get worse. And yes, we do need rate cuts to help offset some of this deficit spending and interest costs. Let's take a look at this chart of federal government current tax receipts in blue against advanced retail sales in red. And you can see very clearly where retail sales go, well, tax receipts follow. And right now, what's the issue is we're seeing retail sales roll over and tax receipts, well, they've been pointing higher, but that means they're likely to turn over and head down. Because again, as we project forward and look at the economy and look at the trajectory of where everything's going, well, as Morgan Stanley, as you're going to see here in a little bit, they're saying, look, the real emergency is coming, and for good reason. Let's take a look at this latest data from Deloitte, who said the slowest holiday sales growth since the pandemic is coming amid a faltering labor market. And consumers may be front-loading purchases again, especially if they consider tariffs and other inflationary costs. This from Brian McCarthy. He's a partner at Deloitte, and you can see based on this chart that holiday sales growth is looking to be one of the worst in the last decade, perhaps going right back to the same levels we saw in 2018 and 19 as we headed into the pandemic. And if you remember back in 2015, 2016, we were facing a globally synchronized recession. But I don't think that that's the issue here. I don't think it's about front-running tariffs at this point. I think largely that's done. But let's dig deeper here, because look, it is going to be a mediocre holiday season, and that's at best. Let's take a look at advanced retail sales in red against average weekly hours of production and non-supervisory employees. And this is why I'm saying, look, I don't think there's front running going on here. I think consumers are tapped out. I think they're running out of steam and their spending's about to decline, because aside from wage growth, well, a lot of workers haven't seen any more hours. So yes, their paychecks have gotten a little bit bigger, but not relative to inflation. And again, you look at the slowdown the economy is facing here, a rate cut or two by the Fed isn't going to move the needle. Yes, it'll help, again, the deficit as we issue more debt and roll over the existing debt. But in terms of turning the economy around, well, it doesn't look like that's going to make a difference. And Brian McCarthy added that inflation itself pushes the price of items a bit higher. So that'll manifest itself in a bit of an increase in overall holiday spend. Now, that I do agree with completely here, because again, this notion that everyone's front running the tariffs, I don't really see that. But what I do believe is because the cost to spend money here has gone up because if good prices are higher, well, that means consumers are going to get less for their money. Now, this is a huge problem for the economy because remember, all of this front running the tariffs has led to major inventory overhangs, and that's about to hit in a major way. Because retailers see an import decline through the end of 2025, and as we start to really dig down to the deeper issues here of the economy, it starts to become all about the labor market. So look, whether Cook votes in this next meeting or not, I don't think it matters because she's always voted with Powell. We know that Powell's already said, look, there's highly likely to be a rate cut. So the only question now is, are we going to get one or two? I think based on the CPI data, it's only going to be one this time. I believe that going forward, every meeting is going to be live. But here's what's going to impact the economy over the rest of the year and into next year. The projected full year volume is going to be down from imports 3.4% from 2024. Now, that may not sound like much, but look what they're projecting for January. Well, they're looking at a drop of 19.1% from the previous year and month. And that means that air pocket that we've been warning about is going to hit the economy. Well, you can see it coming, and it's going to start showing up in different areas. And then it's going to all splash down at once. Now, I think it's going to happen before the beginning of next year. We'll see for sure. It depends on how consumers come out and spend. But based on what we're seeing right now, well, Morgan Stanley says the real emergency isn't on Monday, although that's going to little rattle the markets depending on what happens. But again, the real emergency is what's about to hit. And that is they're seeing a faster pace of Fed rate cuts through early 2026. And again, at this point, it's not a good sign. Even though Fed Chair Powell said, look, we've been in restrictive territory, and they've told that because they don't want to spook the markets when they do their next cut, or maybe even next two cuts, and try to get down to what they call the neutral rate. Again, nobody really knows what that is because it doesn't exist. But the real issue at this stage in the game, when the Fed starts cutting, is because the labor market's unwinding. And that's why, my friends, we talked about initial claims last week, 263,000. We got that data on Thursday. That's rising now at a 4-year high. If that continues to push higher and continued claims break that 2 million mark, it is already too late and game over for the U.S. economy. Because if you look at the Fed, normally when we overlay the federal funds rate against average weekly hours of production and non-supervisory employees, that's still shown in blue. What you see is as hours drop, the Fed cuts rates. But look what happened this time. In 2021, hours were dropping like a rock, and well, the Fed was raising rates. They're clearly behind the curve here. And right now, while we see their stabilization in weekly hours, we know that's likely to change in a major way because right now we're seeing further signs demand is dropping. Look what happened in Texas. You're seeing major layoffs now hit the oil industry. And again, that's going to spread from sector to sector all across the U.S. economy. And right now, markets pricing that most investors expect the Fed to pause after December, with the first cut of 2026 coming down in April. Morgan Stanley sees borrowing costs coming down in September, October, December, and January, when the upper bound of the target range was at 3.5%. What Morgan Stanley is saying is, look, we see the economy is going to continue to decelerate. We don't think these rate cuts are going to work. We don't think the trade war is helping. We don't think the tax cut moves the needle either. In fact, we don't see anything that's changing here. And that's the real issue here. It's not just about the fact that Morgan Stanley sees 4 rate cuts, because if they see 4, there's going to be a whole lot more. Because the real emergency we're facing right now, my friends, is the economy is performing under trend and continuing to decelerate. And right now, the bond market says, yes, it's exactly what we see. Because if the 2-year Treasury yield shown in blue continues to decline, well, that means the Fed's going to cut. So we're already pricing in 1 cut this coming on Wednesday, maybe 2, but I think 1 is the bigger probability. And beyond January, well, economists predict the Fed will pause as it assesses inflationary impacts, which tend to pick up in the first quarter. Once that noise clears, we anticipate further cuts in April and July as labor market deterioration continues. So again, the warning that Morgan Stanley is saying here is, look, they think there's going to be inflation in January. I don't think that's going to happen at all. What they're saying is the labor market's going to continue to weaken. As that happens and spending power declines and inventories still stay too high, you're facing an inventory-led recession, one that is looking very much like a financial crisis. You look at all the debt load, you look at it, people are already falling behind and are entering delinquency. This whole thing is looking to blow up. And previously, Morgan Stanley's been forecasting the Fed to deliver a 25 basis point cut each quarter from this month through December, taking rates below 3%, while now it sees a much quicker pace of cuts. The bank is sticking toward its forecast, and what all they're saying here is, look, the fact that they're seeing a pickup means they think the labor market's going to weaken, and that's exactly what I've been saying here. So as we look now at the real emergency, it isn't about Lisa Cook's board seat. It has nothing to do with that. It doesn't matter how she would vote regardless of that. We do know Powell's going to cut, but what we can say is the Fed's way behind the curve. The problem is we can also argue that a rate cut wouldn't have fixed things to begin with. Because at the same time, companies are backing into the fact we're heading into a recession as corporate allocations, U.S. Treasury debt are maturing in more than 90 days or higher than any point since 2018. So companies are buying into longer term debt. Why is that? Because they know rates are coming down. When that happens, bond prices go up. Notice they're not buying as much crypto, according to this article. They're buying bonds. And they also boosted their share of corporate bond holdings in their portfolio to a 3-year high, which now, according to Clearwater, covers $1.6 trillion in holdings from around 800 firms, most of them U.S. based. So what we're seeing from all aspects of the economy is there's going to be rate cuts. But the problem for President Trump is they're going to be for the wrong reasons. He thinks it's going to be a good thing until he finds out it's all happening because the U.S. economy is sliding faster and faster into recession, which is exactly what Morgan Stanley is predicting. But even if all of that happens, it doesn't mean you can't make money in the market, because again, we are changing the game in the way people trade. Check out our meta strategy. Again, how did we come up with this trade on GDXJ? Well, it came from our meta strategy, but I want you to see the difference here. Because a lot of people say, Steve, you say you optimize it, but it can't be that good. Well, I built a custom backtest engine to handle real world trading. You get the signal and you trade it that very next day, unlike a lot of people, particularly my buddy Jay Bravo says, look, you just buy here and sell there. Well, you can't buy on the moment the signal is generated, particularly if it's based on the closing value. It can't happen. You can't do that. It's not possible. But here's some real world Bravo 9 tests on SPY. You go back 2 years, you can see he's got a total return of 51%, missing buy and hold strategies. He's got a win rate just over 50%, but only 33 trades and a drawdown of 7%. Let's take a look at our meta strategy. Fully optimized at a per security level across every metric. Look at this, total return beating buy and hold, win rate over 66%, and same drawdown. Again, my friends, you can get in on this at no charge. Now, how do you do that? Well, you need to sign up for one of my reports. Now, whether you want to trade against machines, that's our CTA Timer Pro, or you want to trade momentum signals, that's our Momentum Timer Pro, sign up for either one of them right now, included at no additional charge, optimized meta strategy trades. Now, you get the report, you get all the signals from the report, plus some meta strategy trades. You get my opinion on the best trades. We give you risk control levels, a weekly update, a full tracking of all of our open trades and returns. And again, the best part, all you got to do is grab those links in the description below and use a coupon code for your free 30-day trial. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.